Hello and welcome. Before we begin, I need to share something important with you. Everything we discuss today is general information only. It is not personal financial advice. Your situation is unique. Your circumstances matter. So please, before making any decisions about your money, speak with a qualified financial advisor who understands your personal needs. Now, let's talk about something that keeps many Australians awake at night. Tax-free retirement income. Is it really possible? Can you actually stop working and receive money without the tax office taking a slice? And more importantly, will you have enough to live comfortably? If you've been lying awake wondering about these questions, you're not alone. Across Australia, hundreds of thousands of people in their 50s, 60s, and 70s are asking the same thing. They're worried, they're uncertain, and frankly, they're tired of the confusion. You've worked hard for decades, you've paid your taxes, you've done the right thing. And now, as you approach what should be the most relaxing chapter of your life, you're faced with complexity. Rules about superannuation, regulations about Centrelink, talk of age pension means tests and deeming rates. It feels overwhelming, doesn't it? Perhaps you've opened letters from your superfund and felt your stomach tighten. Perhaps you've tried to understand government websites and given up in frustration. Perhaps you've spoken to friends who all seem to have different opinions about what you should do. And underneath all of that confusion, there's a deeper fear. The fear that you might run out of money. The fear that inflation will erode what you've saved. The fear that one unexpected health crisis or one major expense could derail everything you've planned. I want you to know something right now. Those fears are valid, they're real, and it's okay to feel them. In fact, it shows you're thinking carefully about your future. That's a good thing. But here's what I also want you to know. There are genuine strategies available to Australians that can help you access tax-free income in retirement. Real, legitimate ways to structure your finances so that the money you've worked so hard to accumulate can support you without being heavily taxed. That's what we're going to explore today. Together, we'll walk through the Australian retirement system. We'll look at how things used to be and how they've changed. We'll examine the specific rules that can work in your favor, and we'll discuss practical steps you can take, starting today, to move toward a more tax-efficient retirement. This won't be a quick chat. We're going to take our time. I'm going to explain things thoroughly, because you deserve to understand how this all works, not just what to do, but why. Not just the strategies, but the reasoning behind them. So take a breath, get comfortable, and let's begin this journey together. Let me take you back in time for a moment, back to the Australia of the 1970s and 80s. If you're in your 60s or 70s now, you'll remember this era well. Back then, retirement was simpler in some ways. Most Australians relied heavily on the age pension. Superannuation, as we know it today, didn't really exist for the average worker. It was something mainly for public servants and executives. For everyone else, you worked, you saved what you could, and when you reached 65, you hoped the government pension would see you through. The age pension was more generous relative to living costs back then. A couple could live reasonably well on it, especially if they owned their home outright. There was less focus on private wealth accumulation, less pressure to have hundreds of thousands of dollars set aside. Then things began to change. In the 1980s and 90s, the government recognized a problem. Australia's population was aging. People were living longer. The pension system, funded by current taxpayers, was going to face enormous strain. They needed a new model. That's when compulsory superannuation was born. Employers were required to contribute a percentage of your wages into a superfund. At first, it was a small percentage, but over the years, it increased. The idea was simple. Get Australians to save for their own retirement, so they'd be less reliant on the age pension. This was a fundamental shift. Retirement was no longer just about reaching 65 and receiving a pension. It became about accumulation, about building your own nest egg, about taking personal responsibility for your financial future. Now, here's where taxation comes into the picture. The government wanted to encourage superannuation savings, so they created tax incentives. Money going into super was taxed at lower rates than your regular income. Money growing inside super also received tax benefits. And when you reached a certain age and started drawing money out, there were further concessions. Over the decades, these rules have been refined, adjusted, and sometimes complicated. Governments of different political persuasions have tinkered with the system. Contribution caps have changed, pension age requirements have shifted, new tests and thresholds have been introduced. For those of you who've been watching these changes unfold, it's been exhausting. Just when you think you understand the rules, they change again. Just when you've structured your finances one way, new regulations appear. But through all these changes, one core principle has remained. The Australian government wants you to save for retirement, and they're willing to offer significant tax advantages to help you do that, particularly once you reach what we call preservation age, and then, more dramatically, when you reach age 60. Let me talk about the economic context you're facing today. Australia has experienced relatively low inflation for many years, but recently that's changed. The cost of groceries has risen. Petrol prices have fluctuated. Electricity bills have climbed. Health insurance premiums seem to increase every year. If you're on a fixed income or approaching retirement, this hurts. The money you've saved doesn't stretch as far as you'd hoped. What seemed like a comfortable nest egg 5 years ago might now feel inadequate. Interest rates have also been on a journey. For years, they were at historic lows. If you had money in the bank, you earned almost nothing. Then rates started climbing to combat inflation. That's helped savers, but it's also made borrowing more expensive and increased cost of living pressures. Property prices in many Australian cities have soared over the past 2 decades. If you own your home, that's created wealth on paper. But if you need to downsize or move, the transaction costs are significant. And if you're renting, it's become increasingly difficult. This is the environment you're navigating. It's not easy, and that's precisely why understanding tax-free income strategies is so important. Every dollar you can keep, every dollar that isn't eroded by taxation, matters more than ever. So, let's get to the heart of it. How does tax-free retirement income actually work in Australia? The key lies in understanding how superannuation is taxed at different stages of your life. There are 3 phases to consider: the accumulation phase, while you're still working, the transition to retirement phase when you're approaching retirement age, and the retirement itself when you've fully stopped working. During accumulation, while you're working, money going into your super is generally taxed. If your employer makes concessional contributions, those contributions are taxed at 15% inside the super fund. That's usually lower than your personal income tax rate, which is the incentive to save via super. The money then grows inside your super fund. Investment earnings in accumulation phase are also taxed at 15%. Again, this is typically lower than what you'd pay on investments held in your own name. Now here's where it gets interesting. Once you reach age 60 and you've met a condition of release, usually retirement, the rules change dramatically. Money you withdraw from your superannuation becomes completely tax-free. Not reduced tax, not concessional rates, 0 tax. Let me say that again because it's crucial. After age 60, when you're genuinely retired, any amount you withdraw from your super fund is entirely tax-free. Whether you take out $10,000 or $200,000, you pay no income tax on it. This is an extraordinarily generous concession. It's one of the best tax advantages available to Australians, and yet many people don't fully understand it or don't know how to maximize it. There's also something called an account-based pension, sometimes referred to as an allocated pension. This is when you convert your super from accumulation phase into pension phase. You're essentially telling the tax office and your super fund that you're now retired and you'll be drawing an income from your super. Once your super is in pension phase, not only are your withdrawals tax-free, but the investment earnings inside the fund also become tax-free. 0% tax on earnings. This means your money can potentially grow faster because it's not being eroded by the 15% tax that applies during accumulation. There are rules, of course. You need to be at least 60 and retired, or you need to have reached your preservation age and meet certain conditions. Preservation age varies depending on when you were born, but for most people approaching retirement now, it's somewhere between 55 and 60. There are also minimum drawdown requirements. Each year, you must withdraw a minimum percentage of your pension balance. The government sets these percentages, and they increase as you get older. The idea is that you're gradually using your super over your retirement years, not just leaving it to accumulate indefinitely. But here's the beautiful thing. Even with those minimum drawdowns, you're still receiving tax-free income, money flowing into your bank account with no tax deducted. That's powerful. Now, let's talk about the age pension, because this is where things get more complex. The age pension is also tax-free income. If you're eligible for a full or part age pension, that money comes to you without any tax being withheld. However, eligibility for the age pension is means tested. The government looks at both your income and your assets to determine if you qualify and how much you receive. This is where strategic planning becomes essential. Your superannuation balance counts as an asset for age pension purposes once you reach age pension age. The income your super generates is also assessed, but through something called deeming rates, not your actual earnings. Deeming rates assume your financial assets earn a certain percentage, regardless of what they actually earn. If your assets or deemed income exceed certain thresholds, your age pension entitlement reduces. Exceed them by too much, and you receive no age pension at all. The thresholds differ depending on whether you're single or a couple, and whether you're a homeowner or not. This creates a planning opportunity. If you can structure your finances so you remain under the means test thresholds, you can receive both tax-free super income and tax-free age pension income. That's two streams of tax-free money. For some Australians, particularly those with modest super balances, the combination of a part age pension plus super income provides the optimal outcome. They're maximizing their total income while paying zero tax. For others, particularly those with larger super balances, the age pension won't be available, but that's okay. Their tax-free super income is substantial enough to support a comfortable lifestyle. The key is understanding where you sit on that spectrum and planning accordingly. Let me also mention something about investment income outside of super. If you have money in the bank earning interest, or shares paying dividends, or rental income from investment properties, that income is generally taxable. It gets added to your taxable income each year, and you pay tax according to the normal income tax brackets. This is why superannuation is so powerful. Income generated inside a super pension is tax-free. Income generated outside super is taxable. That difference can amount to thousands or even tens of thousands of dollars per year. So when we talk about tax-free retirement income, we're primarily talking about structuring as much of your income as possible to flow from superannuation in pension phase and potentially from the age pension if you're eligible. There's one more technical detail worth mentioning: the transfer balance cap. This is a limit on how much you can transfer from accumulation phase into pension phase. Currently, the cap sits at $1.9 million, though it's indexed and increases over time. If you have more than the cap in super, the excess must remain in accumulation phase, where earnings are taxed at 15%. You can't convert your entire balance to tax-free pension phase if it exceeds the cap. For most Australians, this isn't an issue. The majority of retirees have super balances well below the cap. But for those who've accumulated substantial super, Particularly through years of maximum contributions or strong investment performance, it's a constraint to be aware of. Now, let's talk about the pros and cons of pursuing a tax-free retirement income strategy, because, like everything in life, there are trade-offs. Let's start with the advantages. The most obvious one is more money in your pocket. When you're not paying tax, every dollar of income goes further. If you're drawing $50,000 per year from super in pension phase, you receive the full $50,000. There's no withholding, no tax return complications, just clean, simple, tax-free income. This makes budgeting easier. You know exactly what you'll receive, you're not worrying about tax bills at the end of the financial year, you're not setting aside money to cover unexpected tax liabilities. The tax-free earnings inside pension phase are also significant. Imagine your super balance is $400,000. In accumulation phase, if your investments earn 5%, that's $20,000 in earnings. Taxed at 15%, you lose $3,000 to tax, leaving you with $17,000 of growth. In pension phase, that same $20,000 of earnings is entirely tax-free. Over years and decades, that difference compounds. Your money grows faster. Your balance lasts longer. Another advantage is flexibility. Once you're in pension phase, you control when and how much you withdraw, subject to the minimum requirements. You can take lump sums for large expenses. You can set up regular income streams to match your spending patterns. You have control. And if you're eligible for the age pension as well, you're creating multiple income streams. Super income plus pension income equals greater security. If one source falls short, the other provides a buffer. Now, let's discuss the cons, the challenges. First, getting into this position requires planning. You can't just wake up at age 59 and expect everything to fall into place. You need to have accumulated sufficient super. You need to understand the rules. You need to potentially adjust your working arrangements to meet retirement conditions. If you haven't saved much in super, the tax-free benefit is proportionally smaller. Yes, your withdrawals are tax-free, but if you're only withdrawing $20,000 per year because that's all you have, the absolute dollar value of the tax saving is modest. Second, once your super is in pension phase, you must take those minimum drawdowns each year, even if you don't need the money, even if you'd prefer to leave it invested. The government requires you to withdraw at least the minimum percentage. For some people, this feels uncomfortable. They worry about spending too much too soon. They're concerned about running out of money if they live into their 90s. This is a valid concern, and it requires careful planning and possibly conservative investment strategies. Third, the means testing for the age pension can feel punitive to those who've saved diligently. You've worked hard, you've sacrificed, you've built a super balance, and suddenly you're told you have too much to qualify for the pension. Meanwhile, someone who didn't save gets full pension support. It doesn't feel fair, and emotionally, it's difficult. This is where mindset becomes important. You need to decide whether you're planning for maximum age pension entitlement or maximum overall wealth. Sometimes they're not the same goal. Fourth, the rules can change. Governments adjust super rules periodically. Contribution caps change, transfer balance caps change, age pension thresholds change. There's always a risk that future governments could reduce the generosity of tax-free super benefits. We can't control government policy, but we can plan prudently, stay informed, and adjust our strategies as needed. Finally, there's the complexity. Understanding all these rules, all these interactions between super, pensions, tax, and means testing is genuinely difficult. Many people need professional advice, which costs money. And even with advice, it can feel overwhelming. But here's what I want you to remember. Despite these challenges, the benefits of tax-free retirement income far outweigh the drawbacks for most Australians. The key is education, planning, and action. Let me introduce you to Bruce and Jenny. They're not real people, but they represent a typical Australian couple navigating these exact questions. Bruce is 62. Jenny is 60. Bruce worked as a tradesman for 40 years. Jenny worked part-time in retail while raising their 2 kids, then returned to full-time work in her 50s. They own their home outright in a regional city, no mortgage. Bruce has $320,000 in super. Jenny has $240,000. Combined, they have $560,000. They're both tired. Bruce's knees are giving him trouble after decades of physical work. Jenny's ready to stop working and spend time with their grandchildren. But they're scared. Will they have enough? Let's walk through their options. If they both retire now and convert their super to pension phase, they can draw a combined income of around $30,000 to $35,000 per year, maybe more if they're comfortable with gradually drawing down their balance. All of that income is tax-free. Every dollar goes into their bank account clean. They also check their age pension eligibility. As homeowners with combined assets of $560,000 in super, plus maybe another $40,000 in savings and a car, they're under the asset test threshold for a part age pension. After running the calculations, they find they're eligible for around $15,000 per year combined in age pension payments. That's also tax-free. So now Bruce and Jenny are looking at around $45,000 to $50,000 per year in total tax-free income. They own their home, so no rent or mortgage. Their cost of living in a regional area is manageable. They realize with relief that they can do this. They can retire. They won't live lavishly, but they'll be comfortable. They can travel modestly. They can help their grandkids occasionally. They can enjoy life. This is the power of combining tax-free super income with a part age pension. Bruce and Jenny didn't have enormous super balances. They weren't high-income earners. But with planning, they created a viable tax-free retirement income. Now, let's consider a variation. Suppose Jenny decides to work for 2 more years. During those 2 years, she makes additional concessional contributions to her super through salary sacrifice. She boosts her balance from $240,000 to $280,000. That extra $40,000 in super generates additional tax-free income down the track, maybe an extra $2,000 per year. Over a 20-year retirement, that's $40,000 of additional income. Jenny's 2 extra years of work created long-term financial security. That's a strategic decision, and it's one many Australians face. Work a bit longer to strengthen the foundation, or retire now and accept a tighter budget. There's no universal right answer. It depends on health, on job satisfaction, on family circumstances, but having the information to make an informed choice, that's what matters. Let's also look at what Bruce and Jenny shouldn't do. They shouldn't panic and withdraw all their super as a lump sum to put in the bank. If they did that, they'd lose the tax-free earnings benefit. The money in the bank would earn taxable interest, they'd erode their capital faster, and they'd potentially lose age pension eligibility due to higher deemed income. They also shouldn't ignore their super entirely and just rely on the age pension. Yes, they'd get a higher pension payment if they had no super, but their total income would be lower. The age pension for a couple might be around $42,000 per year. Their current strategy gives them closer to $50,000, maybe more. Bruce and Jenny represent careful, thoughtful planning. They're not taking wild risks. They're not chasing maximum returns. They're building a stable, tax-efficient income that will support them through retirement.
And that's what I want for you, that same peace of mind. So, what can you actually do? What are the concrete steps to move toward tax-free retirement income? Step 1. Know your numbers. You need to know exactly how much you have in super. Log into your account, check your balance, understand where your money is invested. If you have multiple super accounts, consider consolidating them to reduce fees. Also, check your balance on the Australian Taxation Office website using MyGov. This will show you all your super accounts, including any you might have forgotten about. Knowing your starting point is essential. You can't plan a journey without knowing where you're starting from. Step 2. Estimate your retirement spending. How much do you actually need to live on per year? Be realistic. Write down your current expenses, mortgage or rent, utilities, groceries, transport, insurance, health costs, leisure and entertainment. Some costs will fall in retirement. You won't be commuting to work. You won't need work clothes. But other costs might rise. Health expenses often increase as we age. You might want to travel more. Create a budget. Understand your number. Is it $40,000 per year? $50,000? $60,000? This becomes your target. Step 3. Understand your age pension position. Use the age pension calculator on the Services Australia website. Input your assets and income, see what you might be eligible for. This will tell you if you're likely to receive a full pension, a part pension, or no pension at all. It will also show you how changes to your asset levels affect your entitlement. This information is crucial for planning. It might influence decisions about how much to keep in super versus other investments. Step 4. Consider your timing. When do you want to retire? When will you reach age 60? When will you reach age pension age? If you're close to 60, the strategy becomes clearer. Wait until 60, convert your super to pension phase, and start drawing tax-free income. If you're 55, you have more runway. You might focus on maximizing contributions for another 5 years. Salary sacrifice, concessional contributions, catch-up contributions if you're eligible. Every extra dollar you add to super before 60 is a dollar that can generate tax-free income later. Step 5. Review your investment strategy. How is your super invested? Is it in a high-growth option with mostly shares, a balanced option, a conservative option with mostly cash and bonds? As you approach retirement, your risk tolerance might change. You might want more stability and less volatility. But don't become too conservative too early. You potentially need your super to last 30 years or more. Some growth assets are usually necessary. Speak with your super fund's advisors or seek independent advice to ensure your investment mix aligns with your goals and timeline. Step 6. Maximize contributions while you can. If you're still working, consider salary sacrificing into super. This means asking your employer to contribute part of your pre-tax salary directly into super. Those concessional contributions are taxed at 15% inside super, rather than your marginal tax rate, which could be 32 or 37% or higher. There are caps on how much you can contribute each year, but for most people, there's room to contribute more than the minimum employer contributions. Even an extra $50 or $100 per fortnight accumulated over 5 or 10 years makes a meaningful difference. If you have surplus cash, you might also consider non-concessional contributions, which are after-tax contributions. These don't give you an immediate tax deduction, but they boost your super balance and benefit from tax-free earnings in pension phase later. Step 7. Consider transition to retirement strategies. If you're between preservation age and 60 and still working, you might be able to start a transition to retirement pension. This allows you to start drawing some income from your super while still working. The income is taxed since you're not yet 60, but it can be a useful strategy to supplement reduced work hours or to salary sacrifice more effectively. It's complex, so professional advice is important here, but for some people, it's a powerful tool. Step 8. Plan your retirement date strategically. If possible, retire after age 60, not before. That way, your super withdrawals are immediately tax-free. If you retire at 58, your super income will be taxable until you hit 60. That's 2 years of unnecessary tax. Obviously, health and circumstances might dictate earlier retirement, but if you have flexibility, waiting until 60 has significant tax advantages. Step 9. Understand Centrelink rules if you're pursuing age pension eligibility. The gifting rules, the asset test treatment of different investment types, the income test and deeming rates.
If you're close to the thresholds, small changes in how you structure your assets can make large differences in your pension entitlement. For example, certain funeral bonds and home care products are exempt from means testing up to specific limits. Your home is exempt regardless of value. Money spent on home renovations reduces your assessable assets. I'm not suggesting you manipulate the system unethically, but understanding the rules allows you to make informed decisions. Step 10. Get professional advice. I cannot stress this enough. The rules are complex. Your situation is unique. A good financial advisor, ideally one who specializes in retirement planning, can model different scenarios for you. They can show you what happens if you retire at 60 versus 65. What happens if you make extra contributions? What happens if you draw down faster or slower? Yes, advice costs money, but the value of getting your retirement strategy right far exceeds the cost of advice. Look for advisors who charge transparent fees, who explain things in plain language, who don't push products but focus on strategy. Your super fund might offer limited advice for free or low cost. That's a good starting point. For more complex situations, seek a comprehensive advice relationship. Step 11. Stay informed. Rules change. Governments announce policy shifts in budgets. Super funds change their products and fees. Read the communications from your super fund. Pay attention to budget announcements. Follow reputable financial information sources. You don't need to become an expert, but staying reasonably informed helps you recognize when you might need to adjust your strategy. Step 12. Don't panic. Markets fluctuate. Super balances go up and down. Economic conditions change. If your super balance drops during a market downturn, resist the urge to switch everything to cash. That locks in losses. History shows that markets recover over time. If you're already in retirement and drawing income, you might need to adjust your withdrawal rate temporarily during downturns, but panic selling is rarely the right strategy. Remember, you're planning for potentially 30 years of retirement. Short-term volatility is normal. Long-term planning is what matters. Let me also address some common mistakes I see people make. Mistake 1. Leaving multiple super accounts open. Each account charges fees. Those fees erode your balance. Consolidate into one good quality fund unless there's a specific reason to keep multiple accounts, like different insurance benefits.
Mistake 2. Not reviewing beneficiary nominations. Your super doesn't automatically go to your spouse or kids when you die. You need to make a valid beneficiary nomination. Review it regularly, especially after major life changes like marriage, divorce, or the birth of grandchildren. Mistake 3. Withdrawing super as a lump sum unnecessarily. Unless you have specific plans for that money, like paying off debt or major renovations, keeping it in pension phase means it keeps earning tax-free income. Mistake 4. Ignoring insurance inside super. Many super funds provide life insurance and total and permanent disability insurance. As you approach retirement, you might not need this cover anymore, and canceling it reduces your fees. But don't cancel without considering your circumstances. Mistake 5. Focusing only on super and ignoring other assets. Your home, your savings, your lifestyle. Retirement planning is holistic. Sometimes it makes sense to use non-super money for certain expenses to preserve super for long-term income. Mistake 6. Not claiming all the age pension entitlements you're eligible for. Some people feel they shouldn't claim the pension because they're not destitute. But the age pension is an entitlement you've paid taxes towards your whole working life. If you're eligible, claim it. Mistake 7. Making financial decisions based on fear or panic. Fear of running out. Fear of markets. Fear of change. Fear leads to poor decisions. Information, planning, and advice lead to good decisions.
Every one of these steps, every one of these considerations brings you closer to tax-free retirement income, closer to financial peace, closer to the retirement you've earned. Now, let me share something important. Tax-free retirement income isn't just about money. It's about dignity. It's about autonomy. It's about having choices. When you've structured your finances well, when you're receiving reliable, tax-free income, something changes. The constant low-level anxiety about money begins to ease. You stop checking your bank balance with dread. You stop declining invitations because you're worried about the cost. You can say yes to that weekend away with friends. You can help your grandchildren with their education costs. You can replace the car when it becomes unreliable. You can live, not just survive. This is what the third act of life should be, not scrimping and worrying, but relaxing and enjoying. You've spent 40, 50 years working, contributing, raising families, building communities, paying taxes, supporting the economy. Now it's your turn to step back, your turn to breathe, your turn to do the things you always said you'd do when you had time. And having tax-free income makes that possible. It means your money goes further. It means you keep more of what you've earned. It means financial stress doesn't overshadow everything else. I want you to imagine something. Imagine waking up on a Tuesday morning, not because an alarm went off, but because you've had enough sleep. The sun is streaming through your window. You stretch. You make a cup of tea or coffee. You sit in your garden or on your balcony. You have no commute, no boss, no deadlines. The day is yours. Maybe you'll catch up with a friend for lunch. Maybe you'll work on that hobby you've neglected for years. Maybe you'll just read a book. Maybe you'll do nothing at all. And underneath all of that, there's peace, because you know your bills are covered. You know money is coming in, tax-free money, money you don't have to explain to anyone, money that's yours to use as you see fit. That's what we're working toward, that peace, that freedom, that dignity. This is achievable, even if you're starting late, even if your super balance isn't as large as you hoped, even if you've made financial mistakes in the past. It's never too late to start planning, never too late to make better decisions, never too late to take control. Some of you listening are already in retirement. You're already drawing super. That's wonderful. But don't assume you've optimized everything. Review your strategy. Check your age pension entitlement. Look at your investment mix. Make sure you're maximizing the tax-free benefits available to you. Some of you are still working, perhaps in your 50s or early 60s. You're tired, but you're not quite ready to stop. Use this time wisely. Build that super balance. Understand the rules. Plan your transition. These next few years are crucial. And some of you might be younger, perhaps in your 40s or early 50s. You're thinking ahead. That's excellent. You have time on your side, time to contribute, time to compound, time to build genuine wealth inside your super so that when you reach 60, your tax-free income is substantial. Wherever you are on this journey, there are steps you can take today. Today, not tomorrow, not next month, today. Log into your super account tonight. Check your balance. Read your latest statement. That's step 1. Tomorrow, write down your estimated retirement expenses. Be honest. Be thorough. That's step 2. This week, use the age pension calculator online. See where you stand. That's step 3. Next week, book a meeting with a financial advisor. Even an initial consultation can provide clarity. That's step 4. Small actions, simple steps, but they accumulate. They build momentum. They move you forward. And as you take these steps, be kind to yourself. Don't berate yourself for not starting sooner. Don't compare yourself to others. Your journey is your own. Some people inherit money.
Some had high incomes. Some had generous employer contributions. Some got lucky with investments. And some struggled with unemployment, health issues, family responsibilities, or just life. Your starting point is what it is. What matters now is the direction you're heading. And remember, retirement isn't just about money. It's about health, about relationships, about purpose, about joy. The wealthiest retiree with millions in super, but poor health, no friends, and no interests isn't truly rich, while someone with modest means but good health, loving family, and fulfilling hobbies is incredibly wealthy. Money is important. Tax-free income is important, but it's a means to an end. The end is a good life, a meaningful life, a life well lived. So yes, plan your finances, structure your super, maximize your tax-free income, but also plan for health. Stay active, eat well, maintain friendships, pursue interests, contribute to your community. The third act of life can be the best act, truly. The pressures of career building are gone. The demands of young children are past. The mortgage is paid off or close to it. What's left is time. Time to be. Time to explore. Time to connect. Time to reflect. And tax-free income gives you the financial foundation to make the most of that time. Before we finish, let me remind you again, everything we've discussed today is general information only. It is not personal financial advice. Your situation is unique. Please speak with a qualified professional before making any financial decisions. But I hope this conversation has given you clarity. I hope it's reduced some of the confusion. I hope it's shown you that tax-free retirement income is not some impossible dream. It's a real possibility for you. The Australian retirement system, with all its complexity, actually contains enormous advantages for those who understand it. Tax-free super after 60, tax-free pension phase earnings, the age pension available to many Australians. These are powerful tools. Use them, learn about them, benefit from them. You've earned this. You've worked hard. You've contributed. Now it's time to reap the rewards. Take control of your retirement planning. Don't leave it to chance. Don't hope it will all work out. Make it work out through education, planning, and action. The retirement you want is within reach. The tax-free income you need is achievable. The peace of mind you deserve is waiting. Start today. Take that first step, and then the next, and then the next. Your future self will thank you. Your family will benefit. Your retirement will be richer in every sense of the word. Thank you for listening. Thank you for taking this time to invest in your financial education.